Welcome to this Market Intelligence Explainer. I'm absolutely thrilled to have you here today because we're about to decode a wildly critical 48-hour window of data from LVMH, the absolute bellwether of global luxury. And honestly, what we've seen lately isn't just some minor blip on the radar. It's a massive flood of new information that fundamentally shifts the investment thesis for the rest of 2026. So let's dive right in and break down how what looks like a short-term tactical retreat is actually masking a brilliant long-term strategic advance. Here is our executive briefing agenda for today. First, the U.S. luxury slowdown. Second, Japan's currency arbitrage. Third, the pivot to hard luxury. Fourth, AI and family unity. And finally, number 5, the China catalyst. Now, just a very quick note on our methodology before we get into the weeds. This explainer is built entirely on hard data. No speculation here. We are analyzing 3 primary verified documents: an official SEC 8K filing from August 20th, a definitive acquisition press release from this morning, and a verbatim transcript of Bernard Arnault's speech from August 19th. We're cutting through all the market noise and going straight to the source.
Okay, let's dive right into Section 1, the U.S. luxury slowdown, a hard data reality.
So here's the massive red flag the market is completely sweating over right now. Yesterday, in their 8K filing to the SEC, LVMH officially downgraded their core organic revenue growth guidance for fiscal year 2026. This is the sales growth generated from within their existing businesses, completely excluding external acquisitions. They walked it back from a really confident 6 to 8% down to a revised range of just 3 to 5%. Listen, for a powerhouse like LVMH, a downgrade of this magnitude is a massive signal that we need to pay attention to. And the root cause of this downgrade? It boils down to this highly specific number, negative 4.2%. The filing explicitly calls out a 4.2% contraction in U.S. same-store sales for their critical fashion and leather goods division during July. We're talking core staple brands, Louis Vuitton, Dior, Celine. And what's absolutely crucial to understand here is that the filing doesn't point the finger at supply chain hiccups or complex geopolitical issues. No, it specifically blames reduced aspirational consumer spending. In plain English, the entry-level luxury buyer in America, the one who saves up for months for that single statement bag, is pulling back hard right now. This isn't just a tiny bump in the road, it's an accelerating trend from Q2, meaning that lower guidance is, unfortunately, highly realistic.
Moving on to Section 2, Japan's currency arbitrage, the temporary lifeboat.
We are essentially looking at 2 totally different market realities across the globe. On one hand, we have the serious structural problem in the American market with that 4.2% contraction. But, beautifully counteracting that, LVMH also confirmed a massive 12% organic growth surge over in the Japanese market. The primary driver here? The weak yen. This is classic currency arbitrage at play. Japanese consumers and global tourists are snapping up hard luxury goods at a steep discount because the local currency is weak against the euro. And that massively inflates LVMH revenues when those yen are finally repatriated back into euros. It's a huge win on paper.
But, and this is a really big but, I need you to focus on this crucial takeaway. This Japanese tailwind is a remarkably fragile double-edged sword. Because it's purely a function of foreign exchange arbitrage, it's not necessarily reflecting a massive boom in underlying organic demand. It's literally just a currency play. Think about it. If the Bank of Japan steps in tomorrow and decides to intervene to stabilize the yen, that impressive 12% growth figure could evaporate in an instant. So your geographic risk map is highly polarized today. You've got a very real structural demand problem in the US, which is currently being masked by a temporary currency-dependent band-aid in Japan.
All right, let's pivot to Section 3, pivoting to hard luxury, the defensive move. Just this morning, LVMH dropped a definitive press release confirming a jaw-dropping €2.4 billion all-cash acquisition. They are taking a 51% controlling stake in Kering's watchmaking division, bringing in legendary, prestigious names like Girard-Perregaux and Ulysse Nardin. Now, $2.4 billion in pure cash is a massive deployment of capital, even for a giant like LVMH. So the obvious question is, why do this exactly right now, right as U.S. revenues are starting to contract? Well, it's pretty brilliant when you break it down. LVMH is actively hedging its own U.S. exposure by aggressively transitioning its revenue mix. You see, high-volume fashion and leather goods, they are highly sensitive to that volatile aspirational spending we talked about earlier. But hard luxury, like watches at the Girard-Perregaux tier, those target ultra-high net worth buyers. And those individuals are largely completely immune to inflation, interest rate hikes, and general economic slowdowns. By injecting these hard luxury assets into a portfolio that already features heavyweights like Tag Heuer and Hublot, LVMH is actively transforming its balance sheet to be far more recession-resistant. Sure, the risk is in the operational integration, but the strategic reward? Absolutely phenomenal.
Let's shift gears to Section 4, AI and Family Unity, Future-Proofing the Empire.
On August 19th, Bernard Arnault gave a speech in Paris, and we pulled this exact verbatim quote right from the transcript. He said, "This is not about replacing our artisans. It is about giving them a digital twin that can simulate 500 years of leather patina in 5 seconds." What he is actually announcing here is a dedicated €300 million internal generative AI fund. Guys, this is absolutely not a PR stunt. Prototyping premium leather is incredibly expensive and, frankly, super wasteful. By using generative AI to compress those crazy R&D cycles and simulate materials digitally, they are making a massive capital expenditure substitution. This move is specifically designed to actively protect their stellar gross margins, which currently sit beautifully at over 60% against rising raw material costs over the next 3 years.
And alongside operational efficiency, we really have to address the elephant in the room: governance. Social media has been completely buzzing lately with succession rumors, and normally, that kind of noise slaps a 5 to 8% volatility premium right onto the stock price. But yesterday, an official LVMH spokesperson issued this formal, very clear denial. There is no update regarding the governance of the group. The Arnault family remains wholly united. For any serious investor, a statement like that is absolute gold. It takes that near-term succession risk right off the table. The 5 children remain equally positioned, and we know that the huge Kering watch acquisition was a unanimous executive decision. The ship is remarkably steady.
Which brings us to Section 5, the China Catalyst, and that major August 25th Shanghai event.
You are going to want to mark your calendars for August 25th. LVMH just sent out official media invitations for the Louis Vuitton pre-autumn/winter 2026 fashion press preview over in Shanghai. But make no mistake, this isn't just a standard fashion show. This is a highly anticipated economic indicator. Following recent major tariff adjustments in China, the entire global market is waiting with bated breath to see LVMH's brand new pricing strategy for the mainland. This event is going to provide our very first tangible evidence of exactly how they plan to navigate the back half of the year in one of their most crucial global markets.
Because right now, LVMH is completely trapped in a massive China pricing dilemma. They really face 2 incredibly risky paths. Path number 1, they raise prices by more than 5% to just pass the new tariffs straight on to the consumers. But if they do that, they risk severely dampening Chinese volume, exactly like we just saw with those aspirational buyers back in the US. Path number 2, they absorb the tariffs themselves to aggressively protect their market share. But doing that will undoubtedly squeeze their operating margins. Whichever path they reveal on August 25th will absolutely dictate their profitability in Asia. You should brace for immense market volatility around this date, for sure.
Let's bring this all together in our final section. The final verdict: synthesizing threat and response.
Based on all the hard data we've processed from the last 48 hours, here is the clear investment recommendation. If you've got existing positions, the data heavily suggests a hold with a tight stop loss. You really need to wait until the October Q3 sales report to confirm whether that US contraction has actually bottomed out or not. For new entrants, the best advice is to take a strict wait-and-see approach. Seriously, do not buy the dip until after that August 25th Shanghai event drops hard pricing data for China. The macro headwinds in the US are factual, and they are very real. But make no mistake, Bernard Arnault's pivot into hard luxury and AI efficiency is an absolute masterclass in defensive repositioning against what is likely just a temporary speed bump. Patience is 100% the strategy here.
So I want to leave you with one really provocative question to chew on as we watch the data roll in over the coming weeks. Is LVMH's massive strategic pivot into hard luxury and AI really enough to completely outmaneuver a global aspirational spending freeze? Listen, they are making all the right long-term moves, but the short-term turbulence, it's completely undeniable. The story is far from over, and we will be right here to decode the exact next chapter the minute the data drops. Thank you so much for joining me for this explainer, and remember, keep your eyes on the numbers.